Jim Glassman with us, usually with us Friday on Bloomberg Surveillance on radio as the data comes out. You were stuck in an airport in Ohio. This happens.
Yeah, it does happen.
We thank you for coming here on Monday. What did you learn in Friday's report?
Well, we learned kind of what we knew, that because the economy had been growing about 3% or so, the job market was getting better. You could sort of smell that in a lot of the months before, because what was happening is people were working longer hours. Companies are cautious at first, and as the economy looks like it's the recovery more on track, you start to see more hiring, and we saw that. The unemployment rate is starting to creep down for better reasons, but last year it was coming down because people were disappearing. That was not a good thing. We're not seeing people come back into the market yet, which I think is yet to come. And that's why you can't really trust. You got to take a lot of what you see at face value.
I like that. And I like the mystery here. It could be a break exclusive, Rex. Let's do that. The first one this week, Jim Glassman, we're looking at be careful what you observe in economics. Maybe it's the mystery of the American job economy. Dreaded first chart. Here it is. Look down here, Jim Glassman. And you can see here as we bring it up here, there it is. How much decline from recession? JPMorgan out with a lot of research on this. UBS as well. Drew Mattis filling in for you on Friday morning. The labor participation rate rolls over. Some say it's not going to come back, and we're going to see a lower general unemployment rate. Others, like you say, we could even see a reversal here.
Yeah, you see, if what was happening is people are retiring and they're disappearing from the job market voluntarily, then it would make sense. You would expect the labor force rate to be dropping. But when it's dropping in the middle of a recession, that's usually telling you it's because people are giving up. They can't find something.
Well,
they give up.
We're not in recession now.
Well, but the economy is way down on its back still. It's only coming out of a very deep recession.
Stop there. 3% you have for second quarter 2011, 4% real GDP. You've got inflation about 2%. That's 6% nominal. Is that a recession?
It feels like a recession to many people, and this is what I felt when I went out to Ohio. When you get away from New York, it is unbelievably painful.
This is critically important. The phrase Sarah Banner, this Glassman, when you get away from New York, dead on. Tell us about this.
Yeah, I mean, New York, think about it. We are watching markets come back. I mean, we went through a vicious downturn. The markets are coming back. Things are feeling better here. But when you get away from New York and you see what's going on in the rest of the country, it's barely. The economy is maybe stabilizing for a lot of people, but there's a lot of pain, a lot of damage that's been done, and it takes a lot of growth to get out of a recession. So this is why when we all say we're not in recession anymore, most people in this country say, I don't know, it feels like it. And the reason is because unemployment's very high, and there are a lot of people who don't show up in these statistics because they gave up, they dropped out, or actually more impressive, there's an awful lot of people who are working part-time because they can't find a full-time job. That's hidden unemployment. So it takes time to get out of that.
Jim Glassman, what you describe is so much what I see in emails or on Facebook or on Twitter. You studied under Robert Gordon at Northwestern. There's a heritage there of Northwestern labor economics. What are the elites? What are those saying? What are the optimists getting wrong here about this recovering labor economy?
Well, see, I don't think the optimists are wrong in the sense that the economy, the dynamic is their recovery. We are seeing signs of recovery. It seems to be spreading. But I think what people are forgetting is it's hard to sense how much growth we need to get out of the hole that we fell into. We all know that we fell into a deep hole, and we see the growth and we think, well, this is great. But the proof is that there's so much unemployment and the wage trends are telling you the labor market has tremendous amount of slack. That's what most people feel.
Chart 2, folks. I think I may not retire. Okay, 55 to 64, and it rolls over, and that rollover is that participation rate of 65 plus going up. The denominator in that series is getting bigger. Near retirees, it sounds like TV ratings. Near retirees divided by those over 65, and this is economics, folks. You go like this, and this can be the yield curve going like this as well. But seriously, we're all working longer, aren't we?
Yeah, and this is why, see, a lot of people think, well, we're aging as a nation, therefore people are going to drop out, and so you would expect that maybe we don't need as much job growth as we're used to get unemployment down. The fact is, though, that older people are working longer. It's the young people who had a very difficult time in this recession.
Are they one for one? Can you say the young people are not working because of the older people, or is that conflating the two ideas?
It might be that because the job market is so difficult for young people, they can't get a job. Parents may be feeling a little more there's a little more work to do to help them out. So, but I think it's basically everything. Job market's difficult for young people and for older people. We're finding out that we're living longer, thank God, but we've also got financial obligations, and with the market, for many people missing out on the recovery in the market, maybe they're feeling a little more, there's a burden building and they feel more responsibility.
Great. I'm going to go back to your view from Ohio as you went out to the RISE conference there. Let's bring up this note from UBS, and this is something both Glassman and Mattis have been way out in front on. Only 15% or less than a third of a percentage point of the decline in the participation rate that UBS has witnessed during the recession can be attributed to the recession. Okay, I'll buy that. It's this squishy demographics, these cohorts, these deciles, or even finer details of our age demographics, isn't it?
Yeah, but when you see the labor force participation rate dropping like it does in when the economy's gone through a recession, it's very common. This is what happens. The market isn't so great for job opportunities. People give up. It's when the market starts opening up and people hear if there's a job that you start to see them coming back in again. So this is not all that uncommon, although it's very severe what's happened this time.
Excuse me, I got a little bit of the plague, folks. I got it for the Red Sox going 0-3. It's their fault. But Jim, when you look at the employment to population chart, I didn't bring it up for today because I've shown it 2 days
it's
before.
Shocking. It's shocking.
Frame for us what you saw in Ohio, the emails I get from viewers and listeners, to the employment population rate. It's an original decline, as Alan Kruger put it last week.
Yeah, I mean, what that's capturing is capturing not only people who are unemployed and show up as unemployment, but people who disappear and give up.
7 million.
There's an awful lot of them, and that's why that ratio is so interesting, and that's why Ben Bernanke focuses an awful lot on this. When you read all the Fed's documents about what's going on in the economy, it's very, you'll commonly see reference to that picture. It tells you we've lost several decades worth of work in this last recession. We're sort of back to levels that we saw in terms of the number of people employed relative to the population. In the span of 3 years here, we've kind of fallen back to where we were in the early 80s. It's just another way of saying what we all know. This was a very severe recession, and it takes a lot of growth to get back to where we were a couple of years ago. And that's why, folks like Bill Dudley are telling you it's way early to be worrying about what the Fed needs to do. There's just not, as good as the job market report was that we saw last Friday, we need a lot of those.
Months and months and months of them put together.
Years.
I mean, 12 is 2.4 million at 200,000 non-farm payrolls.
Yeah, that's right.
So it's 3 years' work we need.
Yeah, and so the real issue is there an inflation issue or not? And the commodities, you can debate, and the Fed for now, I think, has the right idea. It's transitory and it'll pass. And let's see. We'll know. I mean, a lot of this is reflecting massive crop damage last year in Russia, Pakistan, Australia, China. So now we're going to see, I think over the course of the year, we'll see some of this settle down.
We've talked a little about the fiscal. Let's bring it up here, folks, in search here of the limit. I don't know what the limit is. It's 95. The thing on that chart is in the upper left corner. That's 95% of nominal GDP. Total debt outstanding. I mean, we're becoming like a banana republic. Is that like a typical media smart mouth phrase, or are we really becoming 100% of GDP soon?
Well, if you want to see something worse, just look at Japan. Japan's situation is even worse. So I think you have to ask yourself, why is it with the deficit that we have and debt rising, why is it that interest rates are so low? Well, what the market's telling you is this is all about the recession. And as the economy recovers and the revenues recover, what the market's anticipating is that these revenues will come back, the deficit comes down. The real fundamental issue in the U.S., and it's also an issue in Europe and Japan, is the entitlement area. Healthcare costs, Medicare, Medicaid, because those, if you believe these forecasts, spending for healthcare is going to be growing very rapidly.
If you were Bruce Kasman's team, have you done the math of the deficit's 9% of GDP, how much a cyclical recovery will bring that down?
Well, yeah, most people now look to the CBO as the referee of these kinds of things. So they're saying 3 or 4% is what the underlying structural deficit would be. So what that means is that's not great, but what it means is as the economy recovers, we should expect to see these deficits of 9 to 9.5% come down at least to that level. So for a while, you ought to be seeing an improvement in the deficit.
Let's rip up the script. The idea here of you say we come down to 3 or 4% structural deficit. Here's 0. Here's a structural deficit. Are surpluses a good thing I remember Alan Greenspan suggesting lightly that maybe a budget surplus was not a good thing for a nation.
Well, surpluses are good because if they are used to build a war chest for when you have bad things. But surpluses are a good thing if you can't think of any better way to use the money. But the problem is, what we'll find is as we got surpluses in the last decade, we thought it was a good idea to give it back to taxpayers.
Let's look at a rewind. Peter Hooper of Deutsche Bank. Earlier this morning on Bloomberg Surveillance, I spoke to Dr. Hooper of Deutsche Bank, ex-Fed official. I asked him how much more he thinks house prices will decline.
There's no question that we have some further adjustments down, given the amount of pressure from foreclosures, given also the fact that there's still a significant overhang of vacant homes to be worked off, although that we are making progress.
Peter Hooper of Deutsche Bank, remarkable research by him and Torsten Slok, another 5% decline. But mentally, is that in the nation's psyche right now that we see just a general 5% decline?
It may be in their psyche, but we're not going to feel good about it if it happens. I mean, I think the problem is house prices are now houses are as affordable as they've ever been. So there's no real reason for house prices to keep going down as long as the economy is on a recovery track. But I think right now everybody knows it's a buyer's market, and so the psychology has not turned. And he's right. We've built an awful lot of houses in the last decade, and there's a big foreclosure stress still that we've got to deal with.
Let's bring it full circle. We've talked about jobs, the budget, housing. It still comes down to Akerlof and Schiller's animal spirit.
Yeah.
Are you projecting with your second quarter view 4% real plus roughly 2% inflation? Are we going to have that good feeling of 6% top line GDP before inflation adjustment?
We haven't yet.
We have not yet, correct.
We have not yet. I think it's coming. We've got a little bit of it in the financial market, and we're getting a lot of help from the Fed, because when the Fed pushes short-term rates way down, it encourages people to take risks. So you're starting to see that coming back in the financial markets, which is what you would expect. But we're not getting it in the rest of the country. I don't think people feel like it's time to go out and buy a house because house prices are going up. Or cars are very slow. I mean, 13 million car sales is very depressed. What's amazing to me is the industry can even make money at that level, but they are. So no, we haven't quite got the animal spirits, and I think it might take a little better job market before people start to feel that way, where you think, okay, there's better jobs out there for me.
So what about wages? We didn't talk about wages. They're just not there. 1.7% average earnings.
See, this is why I think this is the struggle that's going on in the Fed's mind. You see these commodity problems, but then you see the fundamental core of the economy, which is supported by labor income, is just really not there yet. Wage growth is very slow. That means demand growth very slow, and so it's hard to get excited about inflation problems. So we're not seeing that yet. And the labor market is just not strong enough yet to generate those kinds of gains.
Jim, thank you. Jim Glassman, folks, JPMorgan.